Hey everyone, welcome to another edition of the Tech M&A commentary for the month of November 2025. As we promised, I think it's been a year where you would see consolidation, and I think we're just seeing the beginning of this trend line. And the bigger companies, as they go public, our belief has been that once you're a public company, there is pressure for growth. And if you see a lot of the companies which are either profitable or public or getting large, will start acquiring. So actually this month, the team has put together the list of M&A in the country. So we have Fitterfly, which got acquired by Policybazaar's new healthcare arm. There's been a hospital space consolidation, which is not uncommon at all. Omega buying Cytecare. And this is not an M&A as much as a strategic move by one of India's larger beauty product companies that's listed, which is Honasa, or also called Mamaearth. They've bought into a chunky stake in an early stage company called Fang Oral. And it shows you, as I said, directionally how strategics are thinking about both full acquisitions, significant minority stakes, and building sort of adjacencies in their value chain. And that's just the nature of the Indian market, where a single product, single idea is never deep enough. And so people tend to build more along the value chain or multi-product strategy. So let's dive right in, and we'll give you a flavor of a little bit of all of these. So as you notice, I'm not a public market commentator, and this is not to influence any views on the stock. But Policybazaar FinTech has been making a big push towards healthcare, and everyone might have noticed that. And recently they raised a significant quote-unquote seed round of 200 plus million, led by General Catalyst, Fairing, Bay Capital, etc. The intent is very clear that beyond insurance, they think health is a very significant part of the insurance puzzle. And rather than sitting in insurance, they're actually sort of backward integrating into the source and the use of where most of that insurance is, which is healthcare. So I think it's a bold move. It's a classic sort of conglomerate-like move. And clearly they're buying into investments of that nature. There is a Mumbai-based digital therapeutics platform. It was born in 2016 called Fitterfly. Clinically validated programs for diabetes reversal, obesity management, heart health, using data-driven nutrition, activity, behavioral coaching. Our data suggests that last year, this year's numbers are not there, but last year they had about only 12 crores of revenue and a sizable loss, 40 plus crores. And has lifetime raised almost 160 crores from Fireside, Amazon's, Sambhav Fund, 9 unicorns, venture capitalists. And the last valuation, as we've seen it from public sources, close to $42 million. And clearly it wasn't sustainable, that loss, and maybe it wasn't growing. But I think PB sees a value of a bolt-on acquisition for proven IP-rich sort of chronic care platform, which is very, very material to chronic care and insurance related to it. And so prevention first, cashless kind of network thesis is what PB Health has been articulating. And this makes like a digital layer, coaching plus data to drive better health outcomes. Interestingly, we have a similar layered product called Complement One, run by none other than Karan Bajaj of ex-White Hat Jr. in our portfolio, who's actually attempting something very similar in terms of its end output in the US market. So we're hoping to get like some big breakthroughs on that front. But as you can clearly see, the healthcare puzzle is so large and complex that you need various pieces of the puzzle to come together. And PB is becoming an aggregator of all of this value. So Fitterfly, of course, gets access to a large capital pool. It probably can just look how much capital PB Health has raised, their distribution, their hospital infra, and hopefully becomes a good accretive acquisition for them. And Policybazaar has done this in the past. They've bought Doc Prime. They've bought a loans marketplace called My Loan Care. So they are beginning to show a muscle to build more value through an acquisition strategy. So that was the first of the lot today. Then the hospital space is always interesting. It is much like the hotel space. Hospitals get built like a chain sometimes a standalone specialty hospitals. And then whether private equity backed or whether a strategic, it's a very, very attractive asset once it becomes cash flow positive. If you've taken the road in Bangalore to the airport, you can't miss Cytecare on the left-hand side going to the airport. It's an oncology hospital, which is fairly well acclaimed. I didn't realize it was a standalone single hospital, 150-bed oncology hospital. But of course, it's probably done well. It had raised about 31 million from Goldman. And our sources say that almost 80 million got raised into this single hospital. And deal value is undisclosed, but Omega Hospitals, which is basically, the company name is Hyderabad Institute of Oncology. So clearly, they're also a multi-center oncology network. It is backed by Morgan Stanley, so big names, big global private equity guys who are buying into hospitals, which is not at all uncommon. So clearly, there's a consolidation. Omega gets an entry into Bangalore's oncology market. There's obviously going to be synergies in clinical protocols, brand, procurement, high-end oncology capex. So it obviously makes sense, this kind of consolidation, and that's what seems to have happened here. And Cytecare has been around for a while. I think the investors were also around for a long period of time, and it's a clean, cash monetization event for all the investors as well. I think clearly the buyer has deep pockets as well in terms of investors. They're probably going to fund the growth of this even further, and so looks like a win-win from the outside at least. So hospitals, I'm not going to be surprised every few months if you find an interesting acquisition. The last one is not an acquisition, but it's a trend line. Again, I don't think it's going to be a surprise. We've seen consumer companies, large and small, buy into significant stakes. Recently, one of our companies, Euler Motors, got like a big check from the Hero Group. It was balance sheet actually. And what does it say? What does it suggest? It shows that a acquirer is looking to not build everything from scratch, but buy optionality and buy into a segment that they're not present in. And here's, Fang Oral is a sort of a premium oral beauty brand, teeth whitening, everyday oral wellness, toothpaste, whitening products. Now, supposedly already has an ARR of about 7 crores as of, mid FY26. I think I've heard this before, that recently a fair bit, that a lot of folks are building into categories that they think can today look like an India 1 or an India 1A kind of category, but are very aspirational for eventually flowing through to India 2. And of course, great success story around Minimalist, as a lot of folks know, almost a 3,000 crore acquisition not too long ago, earlier this year. And happily were my podcast guests recently, so you should look out for that episode. Boatloads of learning on how to think about building and scaling consumer brands, and having the audacity to push out those brands into a global market. And I'm not surprised that Mamaearth is doing this. We had, in our portfolio company, Purple, we've bought Faces Canada, and we always are looking for opportunity sets of this nature. So both legacy FMCG companies like Unilever, new age FMCG companies, and beauty and personal care are all looking to expand product portfolios. And it's a great time to be building in this segment, by the way. So here, I think you got the best of both worlds. You basically get a strategic like Honasa, which is the parent of Mamaearth. And Mamaearth's already shown that it has this DNA. A derma company, Aqualogica, Ayuga, Be Blunt, Dr. Shades, like some of them are homegrown, new brands, some are acquisitions. So they have the muscle to be able to do this. I think I've gotten like a board approval to buy 25% of this with as little as 10 crores. So it's kind of a pre-Series A deal that they bought into, and it looks like both sides are very comfortable with each other to build underneath the Mamaearth flagship, or Honasa as a flagship brand. And historically, Be Blunt, Dr. Shades, these are all through the acquisitive route for Honasa. Again, colorful mix of tech, VC-backed unicorns, public companies, expanding portfolio in the case of our friends at Mamaearth and Policybazaar. Then I think we spoke a lot about banks in the last episode. This time it's hospitals. And I think these traditional businesses tend to always be something that can get consolidated in a growing economy. And so a good flavor of everything that you would expect in terms of consumer, tech, and classic healthcare financial services is what we have witnessed in the last 2 months. So I hope this was fun. The one that we wanted to give a special call out to is also a public company, which has actually also built a reputation for itself of inorganic growth and value creation through acquisitions, which is RateGain. And if anyone has met Banu, is an incredible founder, had almost built kind of quasi-bootstrap to a significant scale. Didn't raise any early stage venture capital, went straight to TA, which is a Boston-based private equity firm. And after that, continued to stay profitable. And I think that was like a pure secondary deal many years ago. And then had the courage to go public fairly early on. And while he has stayed low key, I just checked before shooting for this segment, he's again back at about $1 billion. I think at peak it's been $1.25 billion company, probably IPO'd south of 500 million. The more interesting story is it's almost 70% up in the last 6 months, the stock. And I remember meeting him 2-3 months ago. He's a small investor with us. And was having a chat about how happy he is about where the business is. And he kind of, knew he was undervalued. He kind of hinted that there are a lot of acquisition candidates in the pipeline. I didn't expect it to be this sizable. So RateGain, as for people who don't know, India-listed, AI-powered SaaS for travel and hospitality, usually built its backbone with rate intelligence, channel management, distribution, marketing tech, 3,200 plus customers, 700 plus partners, 100 plus countries. So it's not like a mom and pop store show in India. It's a global play. A great success story of building a verticalized SaaS story for the world. 26 of the top 30 hotel chains and 25 of the top 30 OTAs are customers in some capacity. So they go and find this SF-based AI-powered travel marketing and guest engagement platform. It's called Sojern, Sojern. And these guys focus on demand generation, audience targeting, multi-channel activation, guest experience, and serves like 10,000 travel marketeers. And here's the funnest part. And this is, Oyo did this recently. Bought a budget value chain, hotel chain in the US for, I think, a very small multiple of revenue. And RateGain has done that. And this is something that is fascinating to see. Emerging market leaders in a particular space, like RateGain, buying into mature market cash cow assets for incredibly cheap. This was about a $250 million all-cash deal for Sojern and all its subsidiaries, and bought it via RateGain's new US merger and funded it through RateGain's UK arm. But here's the clincher. Trailing CY24 revenue, only 172 million, a lot of money, but only a multiple of 1.45x. So basically, and supposedly EBITDA positive, it's not like it was bleeding. So this is what happens when you have a super mature asset. Maybe management or founders have moved on. It's generated enough cash flow for all the investors along the way, and it's a cash cow. You tend to get some of these assets really cheap, and then this is super accretive then to stock like RateGain, which is trading at 40 times PE right now, and so you can imagine the impact this might have down the line for them when they've bought in 250 million is not a small chunk of change, but on the other hand, they bought $170 million plus of revenue. I think this business has been around for a long period of time, Sojern, and they have probably getting a full cash exit, which is always super attractive. It gives you a lot of negotiating power. That's the other lesson for founders on the buy side or the sell side. There is a huge premium to landing up on the negotiating table with cash because everybody gets out at that juncture. And if it's a business which can be self-supportive without a need for the existing management team or founders to continue, the cash is just attractive for everybody to take an exit. So we'll wrap up this month's M&A commentary with these stories, but I think a nice blend of how the M&A ecosystem continues to thrive and help the larger tech companies in India become even more, solid and large. And that's kind of what we need to see. We need to see multiple multi-billion-dollar public companies on the tech index in India over the next 5-10 years. And we're beginning to see that motion in bigger waves with every passing month. I hope you enjoyed it.